Hello, this is Jess Riley. I am the Director of Life Insurance Sales here at Insurance Agency Marketing Services. Want to thank you for taking some time off to view this presentation today. I'm going to provide a lot of valuable ideas and concepts to you. And the whole idea of this is to help you to write more life insurance as we move into 2021, and obviously to assist your clients in their needs in the best way possible. So we do appreciate your time and glad to have you here. As you know, there are several scenarios where life insurance can be a huge benefit for businesses, small, large, or in between. And what we want to really hit on is the opportunities that lie in the business marketplace for you. And I'm hoping, again, that this will provide you some ideas or some strategies that you have not been implementing or just need some assistance implementing to grow your life insurance sales for this year. So with that being said, let's just jump right into it here. So this presentation is going to consist of three sections. The first being key person insurance, the second being a buy-sell agreements, and the third being Section 162 executive bonus plans. While we know that some of these ideas or concepts or structures may not be new to you, it's always good to have a refresher on how to structure these so that you can have valuable conversations with your business owner clients, know the right questions to ask in order to help them shore up their business needs. And I think we can help you to do that. So let's get right to it. So first and foremost, as I mentioned, life insurance can be a very powerful tool for businesses of any size, not just your small businesses. Even large corporations can benefit from life insurance in several of the structures we're going to discuss. There are a lot of different ways that can be incorporated, and that's what we're going to talk about today is some of the most common solutions that we see being used. The first one of those is going to be key person insurance. So what we do know is many small businesses rely on the efforts of a few key folks, and those key people are very integral to the success of that company. Without these individuals at the carrier, the company could be at risk of massive profit loss or even going under completely. So key person insurance is designed to provide coverage should one of those crucial employees be unable to work, and that can be due to sickness, disability, or death. So the key person insurance solution, the company is going to be the owner of the insurance policy. They're going to be the payer and the beneficiary. So death is usually the triggering event with a key person policy. So if a key employee were to pass away, that death benefit from the life policy would be paid back to the company. And then, of course, the company can use those funds to offset any of the losses or struggles that can come with losing that key person. And those things can be, just loss of profit or even the time, money, and energy it takes to go out and work on finding a replacement. Sometimes, though, the triggering factor can be a retirement or a disability. And that's why it is real important to keep in mind, while most key person structures will utilize term insurance for the underlying vehicle, there could be some real value in using a permanent plan that has some cash value as well. And we'll talk about that more as we go through the presentation. So again, the background on this coverage, it is there to protect against the monetary loss that this company would face if a key employee were to pass away or become disabled, etc. And it can be set up with any type of life insurance. So again, the least expensive is going to be term, but there are some strong benefits of using a cash value life insurance plan here, potentially indexed universal life. So let's look at the structure as we've discussed it here. So first and foremost, there has to be notice and consent. The business needs to inform that key executive or employee that they are taking out a policy on their life, and that key employee has to provide consent. Again, they're signing off as the insured on the life insurance application, so they've got to be in the know. The business is going to pay the premiums to the insurance company and also be the beneficiary. So if we are working with a term plan, the key employee passes away, the business gets those tax-free death benefits. If we are working with the cash value plan and the key employee dies, same thing. But the cash value can provide us some flexibility. So again, if that key employee were to become disabled or have some other mitigating factor that was keeping them from work, that business could tap into the cash values on that indexed UL product, if that's what we use, to help offset some of those costs. So there's a lot of value there, and I want to make sure that you guys are presenting that as an option when you're talking to these business owners. Most of them think term is the only option, and it's certainly not. In fact, it probably provides the least overall value to that business. So when we're trying to determine how to structure the key person insurance, one of the biggest questions I get is, well, how much coverage do we buy? And so a typical rule of thumb is to look for 8 to 10 times the annual salary of that key employee. And that's your jumping off point. Keep in mind that this is not a set number. You can use whatever calculation that you would like, but this is a good starting point. I wouldn't necessarily recommend going much less than 8 times, just to make sure the company is protected. A key person insurance plan can also be incorporated into a golden handcuff type structure, and it can also be structured as a stay bonus. And there's a couple of things on that. So when you're looking at a stay bonus scenario, what I mean by that is if you have a business owner and they pass away unexpectedly, some of those key executives are going to start to get nervous if they don't have a continuation plan in place. Start maybe thinking, maybe it's time to look for a different job, or maybe wanting to jump ship. The stay bonus, if the business receives that death benefit from the key person insurance plan, they can then use some of those proceeds to go to their key employees and say, look, we know there's a transition period coming up. You are absolutely integral to this business. We need to keep you here. And they're able to provide them with a bonus that basically says, I'm going to pay this to you, and I need your word that you're going to stay here for a certain amount of time, or whatever the structure may be. It's all going to be written in a contract. But that's an area that most people don't consider with key person coverage is, that business owner passes away. You need to make sure that other key employees don't leave. That could be very, very, very detrimental to the business. And so this is a way to help offset that, provide some incentive for those folks to stay on board with you. So that wraps up the key person part. And I want to move on to buy-sell agreements. So when we're looking at a buy-sell agreement, kind of the background on what they are. In short, it's an arrangement between partners or shareholders of a company defining how that ownership stake is going to be split upon a qualifying event. And again, usually we're talking about death here, but it can include disability and retirement as well as the triggering event. So almost all buy-sell agreements are going to use life insurance to fund the actual agreement. And so when that qualifying event occurs, the remaining partners use the life insurance proceeds or benefits to buy out that departing partner's ownership stake or deceased partner's ownership stake, whatever the case may be. So when we look at them, kind of jokingly refer to these as business prenups, because essentially that's what they are. They're an agreement that you get into with your other business owners to make sure that the owners who are left at the company, if one passes away, that they get to maintain the control of the company the way that they see fit. And it also helps them to position the company to handle issues that can come from estates or heirs of the deceased partner. When we look at the buy-sell arrangements, there's generally 3 types that you're going to see. The first is going to be a cross purchase. The second is going to be an entity purchase, and then, of course, a stock redemption plan. And we're going to go through all 3 of these quickly so you can kind of see the differences and determine which is best for the type of business that you may be working with. So we start off with a cross purchase buy-sell agreement. Each owner takes out a life insurance policy on the other owners equal to their share in the business. When a triggering event occurs, most of the time, which is death, the remaining partners are going to use their proceeds to purchase the departing owners or the deceased owners' interest from their heirs. So this is a scenario. We've got 2 owners. You'll typically see a cross purchase agreement. So in this scenario, we've got Arthur and Morgan, who are the owners of the business. So Arthur is going to buy a policy on Morgan's life. Morgan is going to buy a policy on Arthur's life. Again, I would highly recommend cash value plans if it fits into the budget, into the planning, because of the access to those funds can certainly provide a benefit. But if not, at least a life insurance policy with a strong carrier to make sure that death benefit is going to be there for them. So in this scenario, Arthur passes away. Morgan is going to use her life insurance proceed to purchase the other 50% of the business from Arthur's heirs. This is going to give Arthur's heirs the value out of the business that he successfully built, and is then going to allow Morgan to continue running the company on her own without interference from any outside parties. So if the business, so there's some scenarios here that we don't get into often, but if the business were to elect to pay some or all of the premium costs incurred by the partners, they could potentially use a Section 162 deduction to do so. So the benefit there would be that the business is going to get a tax write-off for their portion of the premium they pay. The downside there, though, is that the employer-covered premiums could be taxable because they're basically going to be looked at as income to the partners. And so again, when you're working these types of cases, you profile the case, you profile the business owners, find out what's most important to them, and then we can help you determine which of these structures is going to be the most beneficial. So that covers the buy-sell. Now we're going to move on to the entity purchase arrangement. And so when we look at an entity purchase buy-sell, it's just like it sounds. So the entity is going to be the owner, the payer, and the beneficiary of the policy. So one question I get a lot on this is, well, hey, then the premium should be deductible. That is not the case. There are very, very, very few scenarios where you're going to get a tax-deductible premium and a tax-free benefit. This is not one of them. So again, the business is not going to get a tax write-off, but they're going to maintain ultimate control over the policies because they are the owners and the premium payers and the beneficiaries. So this structure, the business is going to take out a policy on all of the owners. As you can see here, Arthur and Morgan both have to sign off on the buy-sell agreement itself. We're going to use the life insurance policy as the funding vehicle for that. The business is paying the premium. The business is reaping the benefits. The reason, again, that I keep hitting on the idea of using a cash value plan here is, yes, the death benefit protection is extremely important, but if the business owns a cash value plan, they also have access to cash value inside those funds should one of the clients become disabled and they want to use some of the funds to offset some of those costs. You can also buy a disability policy, but I just really think cash value life insurance is going to give us the most flexibility and cover most of our needs under one policy. So that's the entity purchase structure, rather. The business maintains all the control, and they're taking out insurance policies on all of the owners. Business will be the beneficiary and premium payer as well. The last structure that we want to cover in regards to the buy-sell agreement is going to be a stock redemption buy-sell. And that's going to be pretty similar to an entity purchase in that the business is still going to be the payer and the owner of the beneficiary rather of the policy. And they're going to buy a policy on each and every single owner of that company. I think the main difference that you see with the stock redemption design is the valuation that they use within the buy-sell agreement itself. And again, you guys aren't going to be the ones drafting that buy-sell. Their attorneys are going to be the ones drafting that agreement, but you'll be able to provide options on how it can be structured. And once they decide on the structure of the agreement, you can make a recommendation on how we structure the funding of the policy. But again, the main difference here is just the underlying valuation of the company and how that's going to be purchased should one of the owners pass away. Typically, you're going to see this structure used when we have 3 or more partners, and that's pretty general. But again, this is a case-by-case deal. So anytime you're getting in front of these business owners, give us a call. We're going to help you walk through this process and make the appropriate recommendations. So that covers the buy-sell options. And as I've mentioned several times, guys, feel free to call us with any questions on this. I know I'm moving through these things fairly quickly, but you have sales directors here at IAMS that are well-versed in all these concepts, and we can get into more detailed conversations on specific cases that you're working when you have the time. So feel free to give us a call. With that being said, the next thing I want to move on to is executive bonus plans, or you also see them referred to as Section 162 plans. So the IRC Section 162 refers to the part of the code that allows for business deductions. And so while it's a pretty lengthy code, I wouldn't recommend that you go in and read through that line by line. The section that's really relevant here is, in general, there shall be allowed as a deduction all the ordinary and necessary expenses paid or incurred during a taxable year in carrying on a trade or business. So what does that mean? What that means, it allows for businesses to craft non-qualified compensation plans while also getting some tax benefits. The non-qualified compensation plans can be really attractive for a number of reasons. So number one, they're much more flexible than any qualified plan that you're going to find out there. There are no requirements that you offer this to a certain percentage or particular employees. The business owner can pick and choose. They can actually just provide an executive bonus plan on themselves if they would like. But again, they're generally more flexible. They don't handcuff the business as much as a qualified plan. And they're great incentives to attract and maintain some key executives within your business. So same thing as we mentioned earlier, these are not just for large corporations. They can be appropriate for businesses of all sizes. I would add in here, don't forget about 199A. 199A does allow small business owners to get certain income tax deductions depending on their income thresholds. A lot of the kickback we get when we are talking about implementing these plans is some of the smaller business owners may not feel that they have the money available to fund it. If they haven't looked into 199A, they should, because that can certainly be a source of some of those funds due to an income tax deduction that they weren't previously getting. So don't forget to mention that when you're talking to these smaller businesses. So the applications is, how do we incorporate this plan rather using life insurance? And again, with this type of structure, 9 times out of 10, if not 10 times out of 10, we're going to look at an indexed universal life policy because of the growth potential inside the policy and the flexibility. So to start off, we're going to select a life insurance policy or a DI policy that fits their needs. Typically, we're working with life insurance here. And how the structure of this works is that the employer is paying the premiums, but they're paying those out in a form of a bonus. And so the executive is recognizing that bonus as income tax. They will have to pay ordinary income tax on that. The business, however, does get that tax deduction because that is a business expense, just like paying out any other salary or bonus. So the employee, who is the executive, who's going to reap the benefits of this plan ultimately, is going to have some extra income tax. The company, however, is going to be able to get a tax deduction. And here's how the structure looks. We are going to jump into some ways here in a minute of how to offset that income tax concern for the executive. But just on the base level, let's look at the 162 plan in action here. So the business is providing the bonus to the executive. That bonus premium is actually going to fund the life insurance policy. Now, the idea behind this is when the executive does retire and leave the company, they take that life insurance policy with them. One thing to remember, the way this is structured, the executive owns the policy. The executive controls the policy, not the business. The business is simply paying out the bonus to fund those premiums. And so when the executive retires, they have access to all the cash values that have been built into that life policy over the years, and they can use those to generate tax-free funds in retirement, to buy that big rig RV they've been talking about with their wife for the last 40 years, whatever the case may be. It's theirs and they maintain control. And then, of course, when that executive passes away, the life insurance proceed will go to their named beneficiaries. But we want to kind of go through this a little bit because I get questions quite often on the structure and saying, well, how do you restrict the executive from just taking a couple years of funding from that plan and then taking off? I mean, it is his policy. He owns it. He has all rights to it, correct? Well, there are some guardrails or some restrictions that the business can put in place with the executive, and we can do that on a restricted executive bonus agreement, or they're called REBAs. And we can apply certain stipulations to the plan. So if, for example, you can see they can structure this REBA so that the employee is not able to get to the cash value of the life policy for a certain period of time, for example. That's something that you can use as an executive retention tool. It's kind of like a vesting schedule, so to speak. So it's laid out that everybody agrees that, hey, we're going to build this nice plan for you. We're going to pay the bonuses to fund it. But you can't just take this thing and run until a certain amount of time has been met. So again, it is a vesting schedule. It's kind of a golden handcuff type of scenario. And the executive can work with the business to structure that in a way that's beneficial and meaningful for both parties. The other objection that I do get from time to time is I'm looking at it from the executive standpoint. That's great. I'm getting this bonus. I'm getting this tax-free plan. But you're increasing my tax liability because of you're paying this bonus out, so I'm paying higher income tax. So to offset that, you can actually structure this as a double bonus arrangement. And what that means essentially is the company is going to pay out a bonus that's going to be used for the life insurance premium. They're going to pay a second smaller bonus to the executive, and that second bonus is designed to offset any increased tax liability they receive. And so that's a double bonus arrangement, and we use that a lot, ultimately to say, look, yes, we're increasing your taxable income, but we're going to provide you some additional funds to help offset the taxes that come along with that. And that's a real powerful structure. So even looking at certain self-employed individuals, and a lot of structures can build one of these for themselves. I don't think a lot of people are familiar with that or know that, but again, there are certain self-employed folks who can utilize this strategy for themselves, even if they have no other employees. So make sure and give us a call if you run into those types of folks. We would love to help you identify them and build the plans with you to maximize their returns. One thing that I didn't hit on as much, and I think you're probably all somewhat familiar with, is the reason that we want to use an indexed universal life plan on these types of structures is, again, because we have really, really good upside growth potential inside the policy. We have downside protection from market risk, and we've got flexibility. And so if those bonus amounts that the company is paying out vary year to year based on the performance of the executive or company experiences the previous year, whatever the case may be, the IUL is going to provide that flexibility. And at the same time, we're building a tax-deferred account with tax-free dollars that can be accessed in the retirement. So while some plans like 401ks, 403bs, and the like are great to have available, every single penny you get out of there in retirement is taxed. They're going to force you to start taking the income out even if you don't need it at certain ages. And we feel the IUL can provide flexibility that you can't get with those types of plans. So that's why we like to position that. So again, unlike the 401ks or other types of plans, they're not subject to plan limits. We don't have restrictions on how much we can put into the plan per year. We are not subject to the other qualified account restrictions, which is 59 and a half. We have to be at least that age before we take money out if we want to avoid a penalty. We're not subject to that. So if you have key executives who are doing well and want to retire early, the executive bonus plan can provide that vehicle for them to do so, and there's no negative tax consequence there. And then, of course, we're not required to take the RMDs that you are going to have on qualified plans. So a lot of flexibility. And last but certainly not least, if that key executive were to pass away before they utilize the cash values during their retirement, there's a strong tax-free death benefit that's going to be passed on to their heirs. Some policies are even going to have some chronic illness benefits. So there's a lot of benefits here for both the business owner and the executive. I find this to be one of the most flexible and easy to implement plans, specifically in the small business owner space. So I would encourage you to make sure that you're approaching these small business owners with a concept like this, and certainly leaning on your life support team here at IAMS to help you structure the plans. So that's going to conclude our presentation today on our business planning concepts. Again, I do want to thank you for taking the time out to jump on and view this. We feel that even though some of this may be a little bit of review for some of you, it's important information to remember and to refresh yourself on, as that business market holds tons of opportunity. Feel free to give me or any of the other life insurance sales directors a call if you'd like to talk about any of these concepts or work on any designs for any of your business owner clients. Thank you again, and I look forward to hearing from you soon and appreciate the partnership.